Let us do a question on dissolution of firm on page 5.79 of your accounts books. Question number 5. A and B were partners sharing profit and losses in the ratio of 2:1. Their balance sheet as at 31st March 2018 was as follows. Now you have to see which accounts will transfer to relation account from the liability side and from the asset side. Let us begin from the asset side. Debtors will be debited. Provision for doubtful debts will be credited. It is a liability at its original value. Stock, investments and plant machinery will be debited to relation account. B's loan account will be debited to capital account of B because it is the loan taken by the firm. So he owes to the firm. He is a debtor. Since he will not bring in cash, his capital account will be debited to adjust this loan from his capital. From the liability side, we have creditors only. The rest are outside liabilities or liabilities which belong to the partner. Like loan of A is a partner's loan. General reserve will be transferred to A and B in their old ratio or in their profiting ratio. There is no old and new now. A's capital and B's capital will be created, the opening balance. Partners decide to dissolve the firm on the above date. Assets and liabilities realized as follows. Plant and machinery was taken over by A. So this will be credited to relation account and debited to partner's capital account or A's capital account at 60% of plant and machinery. Investments taken over by B at 120%. Investments are 1,50,000. So you will find 120% of that which is taken over by B. This will be credited to relation account and debited to B's capital account. Sundry creditors were paid off by giving them stock at 75% of the book value and the balance in cash. Now creditors are to be paid 2,10,000, but since they have agreed to take over stock at 75%, so 75% of 2 lakhs, you will find that, and you will subtract from 2,10,000 and the balance which comes will be given away to or paid to creditors. Debtors realized 20% less of the amount due from them. The debtors were to be realized 1,80,000. All of it was not realized. 20% less. So 80% was realized. So we will find 80%. This will be credited to relation account by opening by bank account. A's loan was paid off with interest for 6 months. Now A is a partner who has taken loan from the firm. It's a liability. A's loan account will not come in relation account, but it will be shown in A's loan account on the credit side. But interest is an expense to the firm. Interest on rupees 50,000 at the rate of 12% for 6 months will be debited to relation account and credited to A's loan account. Relation expenses will be debited to relation account by opening bank account. You are required to prepare relation account, A's loan account, B's loan account, partners capital accounts and bank account. Let us prepare the realization account. We will debit all those assets except cash in hand, cash at bank, PL account, advertisement suspense account, partner's loan account appearing on the asset side. In this question we have debtors, stock, investments, plant machinery at book value will as this copy or transfer or debit to relation account to close the asset account. Then from the asset side we had debtors less provision. So debtors will always come at its original value and provision will be credited immediately as it is a liability by provision for doubtful debt which is created. It's not actual liability but is created. 10,000. Then from the liability side we have creditors only, no other liability, outside liability and book value. Then we do the posting for assets realized. In this question we have only debtors which have been realized 20% less. So it will be 1,44,000 after subtracting 20%. Then plant and machinery was taken over at 60% of book value. So 60% of 4 lakh is 2,40,000. You will not open bank account, you will open partner's capital account because no cash has been realized but it is through capital account. So by A's capital account, plant and machinery taken over. By B's capital account, investments 120%. So 120 of 1,50,000 directly from 1,80,000. Then the liabilities have to be paid off. Now, if in the question it is not given the liabilities have been paid off, actual liabilities they have to be paid off by writing to bank account creditors paid. Provision for doubtful debts is not to be paid off because it is not an actual liability. It is just created. But creditors are actual liability, outside liability, it has to be paid off. In this question, they have given there is an adjustment that 75% of stock was taken over against their payment of 2,10,000. So remaining was paid in cash. So less 75% of the stock gives you balance of 60,000. Then A's loan bears an interest of 12% for 6 months. So on loan, this is an expense of the business. 3,000 is interest on A's loan. Expense on all this procedure, relation expenses to bank account expenses 1,000. Your debit side is usually more than your credit side. It is called loss. By loss transfer to capital account AB in their 2:1 ratio.